Alright, welcome to video lectures on Chapter 7, How to Deal with Demand Uncertainty. This topic also relates to marketing, the four concepts. Demand uncertainty. What do we mean by that? Break-even point is a way to deal with it, along with it the margin of safety, and then multi-product break-even. When we have more than one product, how do we deal with it? Let's start with demand uncertainty. Cash flow from operations is a good indicator of a firm's profitability. But are all input factors easy to estimate? So let's see what we mean by that. So when you come here, so here is our cash flow for the two products, and it is telling when you reach your target demand, you're going to make 79,200 from your first product every subsequent year. So if you divide that by 2 between you and your partner, that's about a $40,000 income, additional income coming from the side business, which is pretty good. On top of it, when you do the second product, there is an additional income of roughly 17,000 for each of you. So it seems like that's pretty good, because this is your dream, this is your DNA, and this is a side income you are getting in addition to long-term happiness. And 57,000 sounds pretty good, or 40,000 just from your first product sounds pretty good. But the question is, how reliable are these estimates? All the numbers that went into it from Chapter 3 revenues to Chapter 4 costs, are they all reliable, is a question we are asking now. So the answer is not at all. Are all input factors easy to estimate? Not at all. The cost estimates, for the most part, are fairly reliable. Remember, we said costs are difficult to identify, but not so difficult to estimate. Once you identify, you can get on the phone and call a place where you're going to buy a resource, and you can check it. You can check it from Google. Similarly, on the revenue side, the price is fairly reliable. We started with 10, then we settled on 15. The demand growth, the first year is 80%, second year is 90%. That is also fairly reliable. But the target demand is a highly uncertain number. We started with 20,000 t-shirts that we would sell every year. Then with the adjustments we made, came down to 14,000. That's a highly uncertain number. Right? So what problems does an uncertain demand cause? Whether the predicted profit is positive or negative, in our case for the first product 79,200, depends critically on how optimistic or pessimistic the decision maker has been in his target demand estimations. For example, what is the impact on steady state profit if the target demand is half of what was predicted? So if you come back to our Excel sheet, we are predicting a steady state of 79,200 for the first product. But this is assuming your demand is 14,000, right? And the price is 15. But let's say you charge 15, and you found this demand becoming 7,000, half of it, right? Because it's a highly uncertain number, and if it's half, well, what's going to be the impact? So we come down here and we find, surprisingly, our steady state profit is only 10,600, right? So this is kind of serious business. So that's what we are saying here. What is the impact if the target demand is half of what was predicted? Cash flow from operations from product 1 is only 10,600. Significant drop. 8 times was around 80,000, now comes to 10,000. So partners will make significantly lower profits, that you're going to make only 5,000 every year. So given its impact on profit, you would say, well, this is a problem, right? Demand is a highly uncertain number, so your profit estimates are highly uncertain. Should you do market research? Should you hire a market research firm and conduct market research? Well, market research is a good idea, but it too has problems. First, market research can be very costly, right? You're talking about only around $40,000 per person in the steady state, but market research can be pretty costly, pretty much eating up your profits. Second, market research can only reduce uncertainty. It cannot tell your demand is going to be 13,500. It may tell you, well, it's not going to be 14,000. It's somewhere in the range of 10,000 to 13,500. So you still have uncertainty. What if it happens to be 10,000? So as such, the basic problem of the demand uncertainty still remains. And so before we go to market research, is there anything else that you could do as a decision maker that accounting could give you, whether accounting can give you a tool? But let's first stop and think. A practice quiz. Which of the following is not true about uncertain demand? If demand increases, profit will generally increase. Is that true? If demand decreases, profit will generally decrease. Is that true? Uncertain demand makes profit uncertain. Uncertain profit will not impact the decision to invest. So one of these statements is not true. Pause the video and see which will be your pick. The correct answer is D, because everything else is true. If demand increases, profit will generally increase. And there are situations where the reverse can be true too. Generally, if demand decreases, profit will decrease. Therefore, uncertain demand makes profit uncertain, can be high or low. But this is not true. Uncertain profit, you will find, as we will see soon, if the margin of safety is very small, you may not want to invest in the business. It becomes too risky, right? So let's go to second one, break-even point. This is the way we deal with uncertain demand. What is it? How then should a manager deal with demand uncertainty? Rather than hiring a market research firm, calculate the break-even point. What is it? So look at your profit demand line. So currently our target demand is 14,000 units. Our profits is 79,200. So that's our point. Our concern is what happens if this uncertain demand happens to be lower. If it is higher, that's good, you'll make more money. If it happens to be lower, what will happen? Obviously the profit will come down. So this line, this is the profit demand, or people say cost volume profit line, and you see at some point it's hitting zero. So as long as your demand is above this point, you're going to make positive profits. But lo and behold, if it goes below this, you're going to make negative profit. That means you're going to lose money by pursuing this business. So this point, the break even, where you just make zero profit, but remember, this gives you lifelong happiness, so you're happy to do it because it's your dream, and if you're not losing money, then it's still pretty good. But if you start losing money, then it becomes a question whether you want to pursue this or not. So to get to calculating that break-even point, let's focus on a notion called unit contribution margin. Unit, every unit, what does it contribute? Unit contribution margin, or UCM, is the operational cash flow that each additional unit brings. When you sell one more t-shirt, how much does it contribute towards your profit? It's also the slope of the it's not IV, this should be profit demand curve. Sorry for the typo, it should be the profit demand curve. So more precisely, unit contribution margin is price minus UVC, which is the unit variable cost or variable operational cost per unit. Like in our case, the price was $15, but every time somebody pays us $15 and buy a t-shirt, our cost is $5.20. You know, you got to pay the Mexican supplier, you got to pay for the ink, you got to pay for the labor. So really, it's not $15 that goes towards the profit, because out of the 15 you got to incur 520. So price minus unit variable cost is a contribution towards the profit, and that interestingly is the slope of the profit demand line as well. So what factors increase unit contribution margin? Obviously, if you charge a higher price, you find the difference between price and unit variable cost. If price increases, that thing is going to increase. Unit contribution margin will increase if the unit variable cost decreases. If your cost comes down, again this gap is bigger, so each unit contributes more. Often though, the unit variable cost is lower for firms willing to incur a higher fixed cost. The two tend to be related. For example, investing in a high-end assembly line and spending more money will be more energy and material efficient. So the amount of utility bills and the material that is needed, the wastage will be lower, but you got to be willing to incur more fixed costs. So operating leverage, so we can't just talk about lowering the unit variable cost, because the two tends to go together, particularly when you are making decisions up front. Do you want to use a cheaper machine and it will make more defects and cost more energy, or do you want to spend more money and save on material and energy? So operating leverage is a measure that capture the trade-off between the two. So what is operating leverage? Operating leverage is a measure of the fixed cost relative to total cost. It takes a value between 0, which means no fixed costs, and 1, which means all your costs are fixed costs, like some of you who are doing app and subscription services would have. More precisely, the definition is operating leverage is fixed operational costs divided by the total, fixed plus variable operational costs. So unit contribution margin, or the slope, will increase when the price is high or when the operating leverage is high, because if operating leverage is high, greater fixed costs, that means lower variable costs, and if lower variable costs, the unit contribution margin will be higher. So now let's try to express the profit in terms of an expression. So if you don't sell anything, right, then you got to incur this fixed operational cost, because doesn't matter what your demand is, you got to pay your rent and you got to pay your insurance. So then your profits will be negative of your fixed operational cost. But for every unit you sell, you may get a price, but finally price minus unit variable cost, this is what it is contributing towards profits. But first you got to recover your negative fixed operational cost. But at some point you have generated enough contribution to pay off your fixed costs. After that, every additional unit is a profit, right? So the profit here is, what we mean by profit is the operational cash flow. So let me maybe go up to this graph. Okay, all right, if you come to this, so if you don't sell any units, here we have your variable cost. I think it's $58,000 for one product, but after that, for every unit you sell, this slope is the 9.8, 15 minus 5.20, so it starts contributing $9.80. But only around here, the 980 times this point exactly recovers your fixed cost. So that's your break-even point. Then after that, every additional unit you sell contributes to positive profits. Okay, so let's come here. So how do you calculate the break-even point? So basically, you say, to recover my fixed operational cost, if every unit contributes this amount of money, you divide fixed operational cost by this to find your break even. Or if you come here, break even is basically profit is 0. So if profit is 0, to find the profit equals 0 point, you bring this minus fixed operational cost on this side, then it will say fixed operational cost equals UCM times demand, and then you find what is the demand at which profit is 0. That will be fixed operational cost divided by this. Okay, let's stop and think about break-even point. What will cause the break-even point to increase? If break-even point is fixed operational cost divided by unit contribution margin, which is price minus unit variable cost. What will cause break-even point to increase? Decrease in fixed cost, decrease in unit variable cost, decrease in price, or increase in price. I think there was a typo in the book here, and I would use these four. Take a minute to see which would be your answer. The correct answer is increase in price. Intuitively, if you think if price increases, you're going to have more contribution margin per unit, so you need less units to break even. I'm sorry, let me see, if the decrease in price is the correct answer, C, because if price decreases, you're not going to have much unit contribution margin, then you are going to need more units to increase. If fixed cost decrease, then you have, your fixed cost amount is small, then you don't need a whole lot of units. So if fixed cost decrease, break-even point will decrease. If unit variable costs decrease, that means your unit contribution margin, price minus UVC, will increase. If that increases, then break-even point will decrease. So whether price is increasing or variable cost is decreasing, unit contribution margin increase and break-even point will decrease. But if price decreases, then this gap is shrinking, then to recover the fixed cost, you're going to need more units. So the correct answer is decrease in price. Everything else is going to make the break-even point to decrease. Okay. Third point, margin of safety. Third concept. What is the margin of safety? Margin of safety is we calculated the break-even demand. Your target demand, what you initially estimated to be target demand, and your break-even demand is the gap there. So if you come here, you see this is our target demand, 14,000, and so 14,000 our target demand minus here is our break-even demand, right? This distance is the margin of safety, the safety you have. Even if demand drops, you're still making positive positive profit, right? So this would be margin of safety in units, right? So target demand minus break-even demand. But the problem of margin of safety in units is it cannot be compared across products. Like my margin of safety in units may be 20,000 units, and yours may be 200,000 units, and that doesn't mean yours is necessarily safer, because it depends on what is our overall target demand. So what we do is we talk about percentage margin of safety, right? What percentage margin of safety is compared to our demand. If this is 100%, this margin of safety is what percentage? By what percentage demand can drop is a number that we can compare. So it's basically percentage margin of safety is we take target demand minus break-even demand, we divide it by target demand, right? Percentage margin of safety is comparable across product. PMS measures the extent to which demand can drop before profit becomes negative. A low percentage margin of safety, if that space between target demand and break-even demand is just low, like 10%, right? A low percentage margin of safety is indication of a risky business, in that a small drop in percentage sales can make business unprofitable. So there is a concept called DOL, degree of operating leverage, right? So that is a useful idea, because it says if there is change in demand, percentage change in demand, if it changes by 10%, by how much is profit going to change, right? Because if this DOL is large, if this changes, say DOL is 5, so if demand changes by 10%, profits are going to change by 50%. So it's a useful number. Surprisingly, you find, so note that if DOL is large, the impact of demand uncertainty is very significant. Surprisingly, degree of operating leverage is 1 over percentage margin of safety, right? In other words, percentage margin of safety is an inverse measure of risk. If margin of safety is small, like 5%, 1 over 5% is 20. So then if this changes by 5% times 20, profit, you will lose all the profit. So lower the percentage margin of safety, the greater the risk, because the greater the degree of operating leverage. So let's take a quiz on margin of safety. Suppose percentage margin of safety is 5%, that the distance between your target demand and break even is just 5%. Which of the following is not true? The business is very risky. If demand drops by just 1%, profit will drop by 20%. If the demand increases by 1%, profit will also increase by 20%. One should invest in the business and seek to increase demand. Take a minute and see what will be your answer. The correct answer is D. Obviously business is risky, because 5% drop, you're suddenly going to lose all the profits. But 1 over 5% is 20, that's your degree of operating leverage. So if demand drops by 1%, profits will drop by 20%, right? And if demand drops by 5%, then your profit will be completely wiped out. The flip side, if the demand increases by 1%, profit will also increase by 20%, or if demand increases by 5%, profit will increase by 20%. So therefore one should invest in the business and seek to increase demand. if you increase demand, profit will increase, but I mean, you made your best estimate. It may not be easy to increase demand. It may be safer to say, no, this is a risky business, stay away from it, because people will be reluctant to give you loan, as we would study next week. Okay, our final concept, break-even analysis with multiple products, like when you add the second product, some of you have a third product. Now how do we think about break-even? What problems do multiple products cause for break-even analysis? When there is uncertainty of demand of multiple products, you don't know how many t-shirts am I going to sell, you don't know how many caps. Well, there are infinite ways to break even. You could just break even just by selling certain amount of caps, certain amount of t-shirts, the mixture of the two. Then it gets, and then if you have more units, it becomes even more complicated. So the whole idea of margin of safety and degree of operating leverage gets complicated. But how do firms get around this problem? The sales mix across products does not change considerably when demand changes. So if you come to our case, remember in chapter 6, we assume every time we sell, now this, I need to get this back to 14,000, right? You sell 14,000 t-shirts, you sell 7,000 caps, so you sell 2:1. Yes, we are uncertain about, is this 14,000 or is this 28,000 or is this 7,000? But we are not that concerned about this ratio being 2:1, right? This will be 2:1. But what we are not sure is whether it is 14,000, 140, 28,000 and 14,000. So if we are willing to make that sales mix assumption, as we would do here, 2:1, and we are not selling anything, that then becomes a great help for us, because then you would see we can draw our profit demand line in terms of, instead of demand of one product, we can talk about revenues from all the products. And if the revenues, so for example, for us currently the total revenues from caps and t-shirts are 262,500, and our total profits were 113,300, because we got 79,200 from one, and we got 34,100 from the other, and total sales is this 262,500, right? So, and then now we say, okay, what happens if that is 90%, 80%, 70%, and here is your line. So now we can talk about this. It's just that when sales drop, always the ratio is 2:1. That's a reasonable assumption. It's like our 80%, 90%, 100%. But then you see everything looks similar to the first one, except the slope is now is what's called contribution margin ratio, and this is your fixed cost. So we will go back and pick it up here. So how do firms get around this problem? Sales mix across products does not change considerably when demand changes. As such, firms assume a constant sales mix to simplify the break-even analysis. When that happens, uncertain revenues replace uncertain demand. Contribution margin ratio replaces the unit contribution margin. So now we don't talk about how much does one unit contribute, we talk about how much does $1 contribute, but assuming that the sales within that dollar are in this 2:1 ratio. So contribution margin ratio is, we say revenues minus variable costs. That's the total contribution margin, you divide by revenues. So the profit revenue line replaces the profit demand line, and contribution margin ratio is a slope. So if you come here, you see this line now. This contribution margin ratio is 0.664. So it says every time you sell for $1, 66.4 cents is a contribution towards a profit. But you got to recover your total fixed cost of 61,000. So 61,000 divided by 0.664 is your break even. So here you have this. What is the algebraic expression? We say profit equals, if you don't sell anything, you're going to incur a big loss of your fixed operational cost. But as you sell $1, this 0.664 times this. As you sell $100, it's 66.4 will be your contribution margin. So the profit here is the operational cash flow. So break even is, when is this going to be 0? So you bring this to this side, CMR comes down. So your operational fixed cost divided by contribution margin ratio. So a lot of things look similar. What is margin of safety? Is target revenue minus break-even revenue. So here is your target revenue minus your break-even, and you can see here the margin of safety as a percentage is little more safer. So percentage margin of safety is target revenue minus break-even revenue divided by the target revenue, right? So let me, it's not predicted revenue, that is target revenue. The same thing, the degree of operating leverage is 1 over percentage margin of safety. So percentage change in profit as revenues change is this DOL determines that. So the rule of thumb is, if your percentage margin of safety is less than 10%, that's pretty risky. If it is more than 50%, that's pretty safe. Between 10 and 50 is kind of average risk. So here is that if demand changes by 10% or revenue changes by 10%, your profits will change by degree of operating leverage, that is this slope times this, right? And in this case you can see the degree of operating leverage is more than 1, because when demand changes by 10, profit is changing by more than 10%. Okay, suppose incremental value is 100 and not incremental value, sorry, suppose profit or operational cash flow is 150,000 and degree of operating leverage is 2. Now suppose revenues drop by 10%, keeping sales mix constant. What is the revised profit? Is it 20,000, 30,000, 120,000, 130,000? Take a minute. Correct answer is 120, because if revenues drop by 10%, profits will drop by 2 times 10%, 20%. So 20% of 150 is 30,000. So profits will drop by 30,000 from 150. So 150 minus 30,000 is 120. Okay, hope that helps. And you post your questions on question for Coach T.